For our assignment, we decided to do a comparison of Home Depot and Lowe's. So let's begin. We'll start off with a breakdown of the ownership of the two companies. Home Depot has 1.5 billion shares outstanding, with 72.96% of shares owned by financial institutions. A little over 1% are owned by mutual funds, and 2.85% of the shares are owned by insiders. Lowe's has 1.13 billion shares outstanding, with very similar numbers owned by financial institutions and mutual funds. However, only 0.7% is owned by insiders. To compare the two, Home Depot has almost 1.5 times as many shares outstanding. The majority of shares of both companies is owned by large financial institutions. However, Home Depot has 4 times the amount of stock owned by insiders. Let's look at a few ratios relating to debt and cost of capital. Home Depot has a significantly higher debt ratio, but the debt to equity ratios of both companies is very similar, with Lowe's being slightly higher. The cost of capital for Home Depot is 7.04 and Lowe's is 7.52. Although this number might be slightly different from some financial websites, our calculated beta based on 5-year monthly returns for Home Depot is 0.81. Based on the same data, Lowe's tends to move much more in line with the market, with a beta of 1.04. If we look at data over a shorter period based on weekly returns, Home Depot's calculated beta moves up to 0.94. At the same time, when we look at this data, Lowe's beta goes down significantly to 0.783. Based on this data, we drew a few conclusions regarding the risk of the two companies. Over the last 5 years, Lowe's risk has been very close to that of the markets, but has been much less volatile over the last 2 years. Home Depot's beta over the last 5 years has been relatively low, but has been more in line with the market over the last 2 years. Both companies have similar costs of debt and costs of equity, with Lowe's weighted average cost of capital being slightly higher at 8.22% compared to Home Depot's 8.01%. We did a quantitative analysis on the financial statements of both companies, and this is the results for Home Depot. Now these are the results for Lowe's. One thing that stands out is that Lowe's debt to equity ratio is much further from the optimal than Home Depot's. Looking at the whole industry, we see that Home Depot and Lowe's are by far the two biggest firms. Lowe's, the second biggest, has a market cap that's over twice of Sherwin-Williams, the third. The question we're asking when choosing our preferred firm is which firm has more room for growth if capital structure is optimized. If Home Depot optimizes capital structure, there would be a 0.19% decrease in weighted average cost of capital and a $3.21 increase in value per share. However, if Lowe's optimizes capital structure, there will be a 0.5% decrease in weighted average cost of capital and a $4.63 increase in share value. For this reason, we chose Lowe's as our preferred company. While Home Depot is the larger firm, Lowe's has more room for growth. But judging by our analysis, we believe that both firms are undervalued.